Okay, so we're in the process of understanding how equity can go up and down. So jumping back into the series of questions, which you should have just attempted, we're going to start off by recognizing that this business starts with $70,000 of equity. We calculated that at the top of the page in your notes. 100,000 in assets minus 30,000 in liability gave us 70,000 in equity. Now, going from there, we have our first question. If the business owner withdraws $20,000 from the company for home repairs, how much equity is now in the business? So, understanding that putting money into a business makes equity go up and taking money out makes equity go down, we're going to go ahead and attempt this question. So we start off with 70,000. And then we've removed $20,000. So we're going to take that off, right? So when you take money out, equity goes down. And we do a simple math calculation here, and we're left with $50,000 in equity. Now, we have a second question. If the business owner transfers an old vehicle worth $5,000 to the business, how much equity is now in the business? And we're going to assume the first question doesn't count, that there's still $70,000 of equity before the transfer. So 100,000 in assets minus 30,000 in debt equals 70,000 in equity, like we had at the top of the page. Now, the first thing to note here is that equity doesn't necessarily equate to cash. So what I mean by that is, and in any investment in the business would increase equity. It doesn't necessarily have to be cash. So in this case, the owner is moving in her old vehicle into the business, and the market value of it is 5,000. It will have a positive impact on the business's equity. So once again, we're going to start off with 70,000. That's your beginning equity. And we're going to add in the value of the new asset. And we're going to have our new equity number of $75,000. So note that this is not the only way that the equity in a business is affected. We can also have net income and net losses, which can move equity up and down. So when you're making a profit in your business, you're essentially increasing the equity in your business. If you're losing money in your business, you're losing equity also. So looking at what net loss and profit is simply revenue minus expenses. So I mentioned earlier that our accounting equation is what makes up the balance sheet. This is what's going to make up the income statement. When you're going to look at the income statement, you're going to see revenues at the top, and you're going to have a list of expenses, and at the bottom, you're going to have net income, net loss, also known as net profit or net loss. So this equation is best explained through common sense, where any business wants to generate more sales revenue than expenses, so there's a profit or income generated. If expenses are larger than revenues, the business suffers a loss. Naturally, business managers aim to maximize net profit in their day-to-day and long-term decisions. If a business generated $50,000 in revenues and $40,000 in expenses last year, what was the net profit? So I'm going to continue on with the video, but just pause for a minute so you can try this and also have a look at the next one. And we'll continue in just a minute in the same video. Okay, so let's go over these two questions. First, we're gonna just go ahead and plug numbers in. So 50,000 revenues, that's pretty straightforward. We have 50,000 here, and that just plugged in for revenues up here. And then we're going to take away our expenses, minus 40,000, and we're going to get a nice round number of 10,000. Because it's positive, we can confirm this is indeed a net profit. Going down to the second question here, it's a similar question. This time it asks us if a business generated $30,000 in revenues and $40,000 in expenses last year, what was the net profit or loss? So in the last question, the question dictated to us it was going to be a net profit, and we got a positive number. We confirmed that. In this case, we're not sure just yet, so we have to do some calculations. So we're going to go ahead and write down our revenues, $30,000 last year, and then take away our expenses, $40,000. And we're going to get a negative number. And this is how we write down negative numbers in the accounting world in brackets of negative $10,000. Now that we've seen that it's a negative number, we can confirm that this was a loss, right? So we can underline loss up there, and we can write that down here too. It's a net loss for the business. The revenues are smaller than the expenses. As you may expect, a quarterly or annual profit tend to increase equity, while a quarterly or annual loss tend to decrease equity. Profits and losses accumulate over time inside a business, which creates an equity account called retained earnings. A portion of net profit or retained earnings may be paid to shareholders, so that's called a dividend. A dividend is similar to an owner's withdrawal in the sense that it reduces a business's equity. So I'm going to stop there again, and you can take your crack at the next 3 questions, and we'll continue in the next video.